Welcome to the very first IJ interview, Infrastructure Journal's video podcast series with innovators and leaders in the world of funding and financing global infrastructure. 6 years ago, the global head of project finance at Royal Bank of Scotland might have been our ideal first guest for this spot, but the times have changed and so too perhaps has the industry. Insurance investors and pension funds have come to symbolize the future of long-term lending and investing in infrastructure. So I'm delighted today to welcome Deborah Zurkow, the Chief Investment Officer of Infrastructure Debt at Allianz Global Investors. Deborah, welcome to the podcast.
Thanks, John.
You've been doing this in one way or another for a very long time. Mm-hmm. What's the advantage of using private finance in infrastructure? Why not just fund infrastructure with public money?
Well, I don't think it's an either or. Clearly, the private sector is anxious to find new ways of accessing stable long-term cash flows at the same time that the public sector would like to increase the number of infrastructure projects that it's financing. So the combination of the private sector and the public sector is one where the public sector is able to leverage the availability of capital in the private sector to expand their growth initiatives at the same time that they're providing an opportunity for those very same private sector investors, pension funds and insurance companies to access long-term stable cash flows which they're seeking. So I'd say it's really a win-win strategy. The other thing is that when the public sector makes a decision as to how they're going to fund a project, they're very focused on the value for money calculation. So it's not a given that all of type X asset will be done singularly through the private sector. We see that in the UK. Some rolling stock is done by the private sector and some rolling stock is being funded directly by the public sector. So it's very much the case where the public sector is looking to how to optimize the efficiency of its capital allocation while providing an opportunity for optimal efficiency in the private sector as well.
And affordability, obviously, a very important part of that equation for the public sector.
Absolutely.
What advantages do an asset manager like Allianz Global Investors and insurance companies in general have over, say, traditional project finance banks like RBS when it comes to providing long-term debt to infrastructure projects?
I don't know if advantage is exactly the right word. What are the differences is probably the better term. And the real difference is that there's a need for pension funds and insurance companies to access long-term stable cash flows. All of them have long-dated liabilities. Many of them are seeking ways to diversify from sovereign bonds. Some of them had covered bonds and the issuance is down under that. So they're really actually asking for long-dated funds. As you know, at the same time, the banks are really saying, gee, long-dated funds don't make so much of a sense on the lending level for us because of the nature of their own fundraising.
Okay. You're a veteran of some of the IJ institutional events. Jessica will
Great
be
events.
pleased that I got that plug in there. At the Institutional Investor Forum in April, there seemed to be a general consensus that project finance banks still have an important role to play in financing infrastructure. Some, like Natixis, have a co-investment strategy, while others speak about a bridge-to-bond type structure. What role do you think banks have in this market going forward, and what structural changes will need to occur in order for that to be successful?
You know, it's a great question, and it's one that everybody keeps bringing up. And my first point, which I feel very strongly about, is it's not an either or. If you look at the numbers that are being produced, be it the EU, the OECD, or the World Bank, the numbers are so huge that it's not possible that any one part of the market can fund all of it. So then the question becomes, what is the most efficient combination of bank and investors, not whether or not it'll be one or the other. I can say from the transactions we're doing now, there's one transaction where we'll come in after construction, there's one transaction where the banks may amortize early, and there's a transaction that we're doing 100% of the senior debt ourselves. So it's a way of saying that depending on the structure, depending on the geographic location, depending on the other funding options that are available, it'll be, I think, a bank and investor option. Then there's a lot of other roles that banks have traditionally played, which I don't think any of the institutional investors will be doing, whether it's revolving credit or facility agents. So there's plenty of places for us to work together. And from my experiences to date, that's what we're doing.
Very good. What about Solvency II? You mentioned regulation there in terms of, I think, the bankings, but what impact might Solvency II have on infrastructure debt, notably from insurers like Allianz GI?
Well, Solvency II is interesting because on the one hand, the headlines are worse than the reality. There are diversification credits for insurance companies. There's a potential for the matching premium. So the number isn't just the straight look at it. It looks like a corporate, but it's longer. At the same time, it is true that real estate has been granted a special asset class result, whereas the infrastructure debt is treated as though it were a corporate. And so it does actually get a much harsher treatment than one would argue it should relative to its credit performance, historical default levels, and the recoveries. I think not all is over on Solvency II. There's certainly a lot of things going on, like the EU long-term investment green paper, where people continue to seek answers from the market as to what they think would make the most sense. And there may be some changes. I can't say, I'm not a regulator, but I think there's an awareness that it's relatively harshly treated given what the credits are. For larger insurers, I think that Solvency II is a factor, just like for large banks. Basel III is a factor. It's not a determinant factor, but it's certainly something you have to take into consideration. What we're seeing across the market certainly is a large number of insurance companies, both on the continent and the UK, who are interested in investing in long-dated infrastructure debt. So certainly it hasn't prevented those institutional investors from having appetite for infrastructure, but it may impact the global amount that's available. So it would be good to do something that helps.
You mentioned the global amount that's available. That's my next question. Does Allianz GI have a global strategy for infrastructure, and can you provide debt to any infrastructure project in the world, or are you limited in that your product will work better in some geographies than in others?
Well, the concept of matching long-dated cash flows, which is what most of these projects generate, to long-dated investors, which is what insurance companies and pension funds are across the world, makes as much sense in other parts of the world as it does in Europe. We certainly would look across the market today and say, yes, this will be a global evolution, but there's very much of an element of walk before you run. These are established markets that we know well, and we're already developing a new market, as you know. This is something that makes so much sense that people think that institutional investors are already investing, and yet they aren't. So I think once we've established, if you will, our beachhead in Europe, I suspect, yes, we'll be looking more globally in terms of where else we can provide opportunities for investors to match up with stable cash flows.
It's a new market for investors, a lot of them. What more can be done to educate them around the challenges and benefits of investing in infrastructure?
You know, I love this question because I think that education is critical to investors for a couple of things. The first is infrastructure, when taken on the whole, what's so complicated? You build a road, you put some cars on it, right? But all of us who are in the market know that this is really a devil in the detail market. And so it's critical that investors understand what they're getting into. Why is it critical? Because it's important that we establish the foundations for long-term growth, and that has to do with ensuring that investors understand. It's also important because it enables investors to get more comfortable with the construction risk, which of course we think is something that investors should be comfortable with because you have the appropriate mitigants. So how do you go about that? Actually, just to throw you some flowers, I think the forums that you all have been putting together are great. In part because they invite investors to participate actively, whether it's through the roundtables and the question and answer sessions. So very much focused on dialogue. I know that there have been an increasing number of panels that involve putting investors and banks and borrowers on the same panel. That kind of innovation is what's going to lead to the transparency that ultimately will give this market the credibility that will allow it to be a sustainable market over the long term.
Final question, which is quite topical this week in Newsworthy, is around Hadrian's Wall Capital. Obviously, they have had to give some money back to their initial investors on their debt fund. Does this deliver a blow to the concept of the debt fund in terms of credit enhancement?
Well, you know, I mean, I think everybody in the market knows that the team at Hadrian's Wall has spent a lot of time promoting the bond market and helping to move it forward. So it's unfortunate that they, for the moment at least, no longer seem to have their funds, although I don't really know, but other than what I read. Whether or not long-term that's going to adversely affect the availability of funds, I mean, I think the good news is that there are a lot of options that are developing at the same time. So I think there's still probably sufficient variety in terms of ways that investors can access this market, that one solution isn't probably going to prevent now the march forward to an institutional market. But it's unfortunate because they really did have a lot to do with getting the market going. So sorry to see them lose their capital if that's the case.
Yeah, no, they were certainly the brand around, I think, infrastructure debt early on. I mean, one of the early movers in that space. So, Deborah, thank you very much. I hope this has been an entertaining experience for you. And do look out for future videos on Infrastructure Journal as we look to promote some of the great minds that we have in our market and some of the great ideas. So visit IJ Online for more information and tune in next time. Thank you very much.
Thanks.